Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on June 19th, 2026. We're Elena and Marcus.
And our objective today is highly specific. We're going to synthesize our proprietary modeling with the prevailing narrative across the street.
Right. The goal is to provide you, the individual investor, with a clear roadmap of the forces actually driving your portfolio right now.
We need to separate the signal from the noise. Because right now, the noise out there is completely deafening.
Yeah, imagine you are driving a heavily modified sports car at 150 miles an hour down a straight highway. The speedometer tells you that you are flying.
The crowd on the side of the road is cheering.
Exactly. But if you listen closely, underneath the hood, the engine is quietly starting to tear itself apart. That is exactly what our internal data is telling us about the market this week.
If retail investors are pouring record billions into the market, you would naturally think the foundation is rock solid.
But when we examine the macroeconomic floor beneath them, we are seeing some very serious fractures.
So let's look at the actual growth data through the OCM PCA model. Currently, our proprietary modeling places the market firmly in a euphoria and reflation regime.
But before we unpack the warnings there, we need to explain how we arrive at that conclusion. What exactly is a PCA model doing?
Right, so PCA stands for Principal Component Analysis. To make sense of it, you can think about a highly sophisticated graphic equalizer on a high-end stereo system.
Because global financial markets generate a massive amount of daily static.
Precisely. Every headline, every minor economic data release, every geopolitical rumor creates high-frequency noise, and it can be blinding.
It distracts investors from the actual macroeconomic trend.
Exactly. The PCA model mathematically filters out all that daily static so we can hear the heavy baseline.
It takes thousands of disparate data points from shipping rates to manufacturing output and isolates the single underlying engine driving asset prices.
It finds the core mathematical signal. And right now, that heavy baseline is global growth.
The OCM factor trends track this growth factor as state PC1. At this exact moment, this growth metric is sitting in the 85.7th percentile.
Which is statistically massive.
Yep.
For you, the listener, that translates to a highly elevated state of growth expectations.
It is the mathematical foundation holding up this entire rally in risk assets.
But this is where we see a glaring contradiction. The consensus across the street is forecasting a completely uninterrupted upward trajectory.
Yeah, market intelligence shows uniform optimism. Institutional targets are confidently pushing the S&P 500 up to the 8,000 level.
And that's entirely anchored on specialized technology and artificial intelligence themes.
I have to challenge that premise, though. If the global growth metric is sitting in the 85th percentile, doesn't that fundamentally validate the street's 8,000 target?
Well, you would think so.
Right, so why is our model flashing a warning if the growth number is that high?
Because in macroeconomics, you have to measure the rate of change, not just the absolute level. Think of the physics involved. The car is moving very fast, but the driver has taken their foot off the accelerator.
So the momentum is shifting.
Exactly.
Yeah.
When we look at the 4-week forward projections in our proprietary modeling, the actual growth trajectory is cooling from the absolute peaks we saw in early June.
The momentum is measurably decelerating.
The engine is running hot, but it is showing distinct signs of late-cycle exhaustion.
So the surface level looks phenomenal, but the internal momentum is fading, which creates a critical question.
Yes.
If the underlying engine is cooling, why is the market continuing to break historical price records? Who is actually supplying the capital pushing these prices higher right now?
To answer that, we have to look at investor positioning. We are currently witnessing a massive collision between two distinct forces.
Systematic institutional traders on one side,
and an unprecedented historical wave of retail capital on the other.
Let's break down the systematic side first, specifically commodity trading advisors, or CTAs.
For the listener who might not be familiar, systematic traders operate on a fundamentally different paradigm than traditional discretionary fund managers.
They are purely algorithmic.
Right. You can picture them as self-driving cars programmed strictly for momentum.
They accelerate when the road is straight, meaning they automatically buy into upward price trends, completely ignoring underlying valuations.
Or fundamental logic. And just as importantly, they are programmed to slam on the brakes at the first sign of a curve.
Aggressively shorting when that trend breaks.
Exactly. Right now, our data shows these systematic CTAs are heavily long on global equities.
And because market volatility has been relatively low, their risk models have allowed them to increase their leverage.
They are essentially on autopilot. riding the straight road of the current rally with massive size.
But those algorithms only account for a portion of the market volume. The variable that is truly distorting the landscape right now is the retail investor.
The numbers we are tracking are difficult to comprehend.
Cash equity volumes in May shattered the previous historical records set back in January 2021.
By a full 10%.
And the momentum is not slowing down. June is tracking even higher.
Yeah, June 12 stands as the largest single day of retail net buying on record.
But it's not just buying stocks outright. The options market is absorbing an unprecedented level of activity.
Recent market intelligence reveals that retail options premium volume hit $7 billion per day in June.
We need to pause on that specific metric, because $7 billion in premium is deceivingly large.
Yeah, extremely deceiving.
Yep.
Let's explain the mechanics of that exposure for the listener.
When you buy an option, you pay a relatively small premium to control a much larger amount of underlying stock.
It is inherently leveraged.
So $7 billion spent on options premiums translates to tens of billions of dollars in actual leveraged market force being deployed every single day.
Add the corporate bid to that equation. Year-to-date, corporate share buybacks sit at an astonishing $926 billion.
With technology and financials making up roughly 57% of that total.
Corporations are placing a massive price-insensitive floor under their own shares.
Wait, if algorithmic traders are just blindly buying the trend, and corporations are buying their own stock regardless of price?
And retail investors are pouring in record billions through leveraged options.
Right. Who exactly is taking the other side of all those trades? Someone has to be selling.
That is the defining question of this quarter.
I mean, is this retail cohort actually the new smart money dictating the market direction? Or are they unwittingly providing exit liquidity for institutional players who are quietly offloading their exhausted assets?
Historically, when retail participation reaches absolute peak levels alongside extreme bullish sentiment, it heavily aligns with periods of institutional distribution.
The smart money uses the overwhelming retail demand to sell massive positions without crashing the price.
Precisely. To determine if that is happening right now, we have to evaluate the macroeconomic floor beneath these investors.
Let's move to that macro and policy backdrop. According to the OCM factor trends, the rates and reflation component, which our model tracks as PC2, is actively decelerating.
It is slowing down, yes, but it remains supported by rigid global pillars.
Specifically, we see ongoing yield support from emerging market debt,
as well as the German and U.S. 10-year yields.
So the momentum of the reflation trade is fading, but the absolute level of interest rates remains structurally high.
Which leads to a severe vulnerability flagged by our proprietary modeling. We are seeing a major regime disagreement on interest rates.
When we analyze the 5-year rolling window, the model points to continued reflation.
But the 3-year window is shifting decisively toward a Goldilocks environment.
Let's define those terms for clarity. A reflation regime involves accelerating economic growth and rising inflation,
which drives bond yields higher.
Right. And a Goldilocks regime implies steady, moderate growth coupled with low inflation.
An environment where the economy is neither too hot nor too cold, allowing yields to stabilize or fall.
The mathematical disagreement between the 5-year trend and the 3-year trend represents a major structural fracture in the market narrative.
The best way to visualize this is the difference between a climate trend and a weather forecast.
The long-term climate model, our 5-year window, suggests things are structurally heating up, which drives reflation trades.
But the medium-term weather map, the 3-year window, shows a sudden, unexpected chill.
When the long-term climate and the medium-term weather disagree this sharply, the consensus across the street becomes highly vulnerable to sudden shocks.
And for you, the individual investor, this fracture directly dictates everyday liquidity.
These subtle shifts in the U.S. 10-year yield serve as the base discount rate for the entire global economy. It acts like financial gravity.
It affects corporate borrowing costs, which immediately impacts profit margins, capital expenditure, and corporate hiring.
It dictates consumer mortgage rates, which drives housing mobility and broad discretionary spending.
Ultimately, the trajectory of the 10-year yield decides whether this current state of market euphoria can actually be funded.
If corporate borrowing costs remain elevated while end demand growth cools, the capital required to sustain these record equity valuations simply evaporates.
Future corporate profits become worth significantly less in today's dollars.
Macroeconomic transitions of this scale take months to fully price in.
But over the immediate next 2 weeks, long-term macro policy is going to take a backseat to short-term market plumbing.
Market intelligence strongly suggests that the next 14 days will be driven almost entirely by flows and structural mechanics rather than underlying corporate fundamentals.
We are facing a massive convergence of events. We are approaching the largest options expiration in history,
Which coincides directly with massive quarter-end pension rebalancing. Millions of derivative contracts will expire simultaneously.
Furthermore, large pension funds operate on strict, fixed asset allocation targets.
If a pension wants to be 60% in stocks and 40% in bonds, and the stock market rallies massively, they might suddenly be 65% in stocks.
They are legally and mechanically mandated to sell equities and buy bonds to rebalance their portfolios.
Regardless of how good the economy looks.
Exactly. To understand why this options expiration is so critical, we have to demystify the concept of dealer gamma.
It sounds like an incredibly dense institutional concept, but it is actually straightforward.
Wall Street options dealers operate very similarly to insurance companies that sell hurricane policies.
If a major storm is approaching the coast, the insurance company cannot just sit back and hope they avoid paying out.
They are mathematically forced to dynamically buy their own emergency supplies and reinsurance to hedge their exposure.
They have to protect their balance sheet.
In financial markets, gamma is simply the mathematical metric that dictates exactly how these dealers must react to changes in the underlying stock price to remain perfectly hedged.
When a retail trader buys a call option, the dealer is theoretically on the hook if the stock goes up.
To neutralize their risk, the dealer buys the underlying stock.
And depending on the aggregate positioning of the market, these dealers act as either shock absorbers or amplifiers.
When dealers act as shock absorbers, their hedging mechanics force them to buy when the market dips and sell when the market rallies.
This counter-cyclical action naturally dampens volatility. It provides liquidity and holds the broader market steady.
But when dealers are forced into an amplifier position, those mechanics brutally invert.
If the market begins to drop, their risk models force them to aggressively sell the underlying stock to remain hedged.
It is not a discretionary choice made by a human trader. It is automated math.
The further the market drops, the more they are mathematically required to sell.
Which creates an avalanche. Right now, market intelligence highlights record-high call-to-put volume ratios.
The retail and systematic momentum we detailed earlier has packed everyone onto one side of the boat.
Investors are overwhelmingly buying call options, betting heavily that the market will continue to rise.
Because the market is so heavily skewed toward long call options, dealers have been forced into a position where any sudden shock will be highly amplified.
The market's plumbing is effectively jammed.
The shock absorbers are offline.
If a fundamental catalyst or a sudden shift in systematic flows triggers a sell-off, mandatory dealer hedging will accelerate the decline rather than cushion it.
They will be forced to sell into a market where there are no buyers.
So knowing that the market plumbing is jammed, and that the underlying growth impulse is actively neutralizing, we need to locate the most dangerous places for your capital right now.
Where is the consensus across the street fundamentally wrong?
The primary risk, often referred to as the pain trade, is cyclical overextension.
There is extreme statistical crowding in cyclical risk assets.
The upward growth drivers in the market are dangerously concentrated in very specific areas that require a booming global economy.
Our proprietary modeling points directly at the MSCI Emerging Markets Index, specifically highly cyclical components like the KOSPI index,
as well as industrial commodities like copper.
Both of these assets are pushing extreme multi-standard deviation highs.
They depend entirely on accelerating global industrial growth.
If our model is correct and the global growth impulse is cooling, these assets are highly vulnerable to a violent mean reversion.
We are also tracking severe tail risk building in the credit markets.
Despite the headline euphoria in equities, our modeling projects significant deterioration ahead for credit spreads.
Specifically, the 4-week base rates model projects high-yield credit spreads to widen by 1.84 basis points.
And investment-grade spreads to widen by 0.56 basis points.
We need to translate what that means for the listener. When we say credit spreads widen, it signals that lenders are demanding significantly more compensation to loan money to riskier companies.
This is particularly relevant for lower-rated corporate debt like BB and CCC bonds.
Exactly. When a company with a CCC rating sees their borrowing costs spike, they struggle to refinance their debt.
It creates a ripple effect through structures like a CLO or CMBS, which hold these loans.
Widening credit spreads are usually the first smoke alarm that goes off before an equity market fire.
Equity markets routinely ignore this underlying financial stress until mathematical reality forces a repricing.
Given these distinct structural risks, we need to synthesize the OCM-PCA model's data into immediate, actionable positioning shifts for your portfolio.
Based on the OCM factor trends, we have 4 definitive positioning mandates for the next 4 weeks.
The first mandate is to de-risk cyclical beta.
You must move capital away from crowded, pro-cyclical equities. Extreme statistical crowding yields negative forward expectations.
If everyone is already in the trade, there is no one left to buy.
For instance, broad cyclicals are modeled to systematically underperform defensive sectors over the coming month as the growth engine cools.
The second mandate. Maintain curve flatteners. You want to position your fixed income portfolio for the yield curve slope to compress.
Specifically, our model mathematically projects the spread between the 2-year and 10-year yield to compress by an additional negative 1.45 basis points.
Just to clarify for the listener, a curve flattener involves the gap between short-term interest rates and long-term interest rates shrinking.
Why is that a defensive move in this specific environment?
Well, because the 2-year yield is heavily anchored by central bank policy, while the 10-year yield is driven by long-term growth and inflation expectations.
As growth slows and the market euphoria cools, long-term yields typically fall faster than short-term yields.
Right. Positioning for this compression directly protects your portfolio against macroeconomic growth shocks.
The third mandate, overweight select real assets. You want to pivot a portion of your capital towards specific commodities that exhibit strong historical asymmetry during a euphoria regime that is beginning to cool.
The model specifically favors Brent crude oil, projecting a 3.2% positive return over the next 4 weeks.
This position should be heavily supported by a defensive allocation to gold.
Gold traditionally acts as a sanctuary asset when the market plumbing gets jammed and liquidity dries up.
Finally, the fourth mandate. Deploy volatility hedges.
The macro growth impulse is neutralizing, and risk assets are structurally exhausted.
We project cross-asset volatility to structurally expand.
Our modeling forecasts the equity volatility index, the VIX, to increase by 1.49 points.
And the rate volatility index, the MBUE, to increase by 2.09 points.
Implementing long volatility structures, which is essentially buying insurance against large market swings, is absolutely essential right now to insulate your portfolio against the forecasted credit widening we just discussed.
The internal data is presenting a reality that heavily contradicts the daily headlines. As an investor, you have to evaluate the underlying mechanics, not the prevailing sentiment.
The consensus across the street is entirely focused on the velocity of the current rally.
But they are completely ignoring the fact that the acceleration has turned negative.
Which leaves you, the listener, with a critical question to consider as you navigate the coming weeks.
If the consensus across the street is treating July as a guaranteed seasonal green light for risk assets, shouldn't the true contrarian view be that this record-breaking retail liquidity is the exact peak the smart money will use to quietly exit the stage?
See you next week, wherever the flows take us.